Good morning. Tim Nyland here for our August 5th internal strategy call for Zacks Professional Services. We've had a lot of the earnings certain portfolio tilts report over the last week, and much of the earnings certain portfolio tilts have actually dominated the news as well over the last week. So what I wanted to do is talk a little bit about some of the ECP tilts making news and look at their performance since we made the official recommendation of the tilts along with the earnings certain portfolio, or really any core equity portfolio. So as we expected, Apple crushed their numbers on all fronts. They literally added 230 billion in market cap since last Friday, since they reported. If you do the math, I could give you a couple names. One that comes to the top of my head pretty quickly is Netflix. But if you add 230 billion in market cap since Friday, that's the equivalent of bolting on a Netflix to Apple's market cap since Friday. And you can see the performance that I have here up on the screen. And this is just obviously using advisor tools. Forget about the fact that it says advanced micro devices up here on the top. That is because I clicked into AMD off the quote monitor to get into interactive chart on the performance chart. And then what I did is I actually put AMD, Intel, Taiwan Semiconductor. These are part of our 5G strategy. But then I also added 5 of the 6 tilts along with the S&P 500. And I did this just for illustrative purposes. So right now we're just looking at the ECP tilts, and notice that Google's not up here. Google was a little bit soft on their numbers. It's still obviously a top performing name as one of the ECP tilts, but these are clearly the significant outperformers above and beyond the S&P 500. So I've actually got the S&P 500 performance here since March 19th at about 37%, and you can see all of the ECP tilts literally leading the S&P 500. So to the extent any of our clients have gone forward with that 25 to 30% tilt that we like with the earnings certain portfolios, because that's where you get that equal weight of technology and equal weight of communication services with Google and Facebook, you can tell that if you were to apply, a 30% weight across these 5, and again, you got to add Google in here, but I mean, you're just, performance-wise, the portfolio is just on fire. It's just killing it. So this was great to see. Again, Facebook is firing on all cylinders. Microsoft as well, now in talks to buy TikTok. This would be great, especially if I think Microsoft could probably get this thing at fire sale pricing. I'm not really thrilled with how that's going down, but at any rate, it is. And this would obviously add huge synergies to their user base. As I mentioned, Google's numbers were a bit soft. And just to kind of show you what I look at, I love going into the institutional platform, the Zacks Research System, and looking at this growth and margin page. It's underneath the financials view, growth and margin, one of my favorite pages. There's literally probably 30,000 lines of code or more that drive this one page. I can remember when Joseph and I designed this thing, how long it took us to put all the rules in place for this page. But what you're looking at here is literally the year over year in the middle here, percentage change in both diluted and aggregate top line versus bottom line growth. And then we actually have sequential quarter to quarter growth as well. And the very first place my eyes go, obviously, is over to this shares diluted, taking a look at the capital structure to see if there's any buybacks going on or what's going on with the capital structure. And that'll tell you whether to bias your growth analysis towards diluted or aggregate. Obviously, if they have a huge share buyback going on and the number of shares are coming down, you're going to get a certain portion of that EPS growth that's going to be attributed to a buyback versus what you would see in aggregate. So you kind of have to weigh the two against one another. But what I want to point out is this goose egg that Alphabet, Google reported in the June quarter, and this is kind of why the stock was a little bit soft. But again, still no issues with Google. I don't think they really got credit for actually chipping away at Amazon's AWS cloud service. They actually took a little market share from Microsoft Azure as well. And obviously, if you look at their forecast growth and top line, we're looking at a nice recovery. So definitely just a soft quarter here, one of the first ones they've really ever had. And I think we give them a pass at that point. But basically what you're looking at is almost a 0% change from the June quarter to the prior June quarter in 2019. So at any rate, that is expected to pick up, and you can see that we actually go from 13% growth on the forecast forward 4 quarters to 14% growth as of the June 21 numbers. So anything that you see here in green, these are going to be your forecast numbers, and then we've got the long-term least squares trend rates here for growth rates, and then the point-to-point. I like to bias myself to the least squares trend rates, especially because it does a really nice job of eliminating cyclicality. Still solid double-digit growth, both top line and bottom line. So at any rate, let's talk a little bit about that 5G portfolio. And again, for any clients that are interested in this, they can obviously get it directly from any of the sales team. They can get it directly from me as well. It is a portfolio that we will end up publishing here shortly. I haven't published it yet, just for the sake of time. Haven't really had a chance to get to doing that. But the portfolio is doing very well, and specifically wanted to call attention to the AMD versus Intel trade that I recommended to all, and specifically to individual advisors that were asking me specifically about Intel. I know that many people hold Intel, and I've not been a fan of it for quite some time, and you can now see why. They basically announced their quarter, I believe it was a week or two ago, and they dropped a bombshell on the market, and they announced that they were basically delaying the fab cycle on their 7 nanometer transistor. And this is obviously the primary technology that goes into their chips. And when you think about the fact that AMD already has 7 nanometer technology built into their chips, this obviously gives AMD an absolute edge in this marketplace. So, you can kind of see here AMD's price just absolutely going parabolic, and Intel's price obviously lagging the S&P 500. So Intel down here in orange. If you bring this down to the 3-month chart, you can actually see it a lot better. AMD and Taiwan Semi. The reason why Taiwan Semi is so important is that AMD does not fab their own chips. They exclusively use Taiwan Semi. So to own one is to kind of own both. I love both of them. Taiwan Semi and Intel are your 2 top chip manufacturers when you start talking about fab. And the problem with Intel is that obviously chip design and fab are all lumped together in one company. And when you talk about AMD, chip design and fab are separated because AMD designs the chips, Taiwan Semi fabricates the chips. So you can see the tale of 2 tapes here, and you'll also see that if I actually take you to the 5G list, I spoke of this from the very first time we kind of unveiled the concept of the 5G thematic portfolio. And I mentioned that at the time there was no Intel, and that's exactly the reason for there being no Intel. AMD is the leader, and we put our money on the leaders. Not worry about the laggards. So these are all still your top names in the 5G space. I did add Apple to this. Again, we had a conference call on this webinar a couple weeks ago. When I mentioned, I went ahead and threw Apple in here as well as Skyworks and American Tower. The 5G super cycle with Apple is real. And again, this was a call that we made, months and months ago. And if you look at what's going on with Apple and Apple stock, and the fact that I've seen estimates from anywhere between, 200 million to 350 million iPhones expected to be updated all within the next year. And if you couple that with the fact that, they're going to need some new AirPods and new iPads and new, Max and everything else. It doesn't take long to figure out, just kind of taking the Warren Buffett approach to buying stocks. It doesn't take long to figure out that this would be a really good investment. Anyway, some other ones in here that have reported that have just had spectacular quarters. I mean, Qualcomm actually inherited, if you will, or worked out some patent licensing from Huawei, which is going to be huge for the 5G infrastructure in the U.S. And this is how Huawei and Qualcomm have gotten around some of the concerns that the Trump administration has had around the Chinese technology being at the forefront of the 5G infrastructure. So Qualcomm has been the beneficiary of that. And again, Qualcomm was one of my favorites, along with AMD and Taiwan Semi. So not a surprise there either. A lot of great one-off names in here doing really, really well. There's a couple in here. One in particular, I definitely want everybody to keep their eyes on. I got to find it. How come I can't find it? Acoustis Technology. Oh, it's at the very bottom. Keep your eyes on this Acoustis Technology company. This is one of the more fascinating plays. They're a small company out on the East Coast. They designed the 5G filters for the phones. And so this filtering technology, I think, could be really, really interesting, because that 5G signal is very, very direct. It's not as dispersed as like a 4G signal. So this company could really take off. So just keep an eye on it. It's at $8 right now. I have it on the list. It's interesting that it's going to get a lot of play in the 5G space. So the last thing I wanted to touch on today was what's going on with equity risk premium and overall market valuations. And this is some really, really interesting times that we are in. And let me show you kind of what I'm seeing here. I'm going to go ahead and put the market into the chart. And again, I've now reverted back to the Zacks Research System. And this is a custom chart that we've produced, and it's available under the custom views. You basically find it by going in here and just going to Zacks default templates, and it's in here. So I've actually got this loaded into a pitch book as well, and everybody has access to this, including all of our clients that subscribe to the Zacks Research System. It's under Zacks Quick Analysis, and it's just the Zacks Equity Risk Premium view. So I've already got it stubbed out the way I like to look at it, and the way most PMs look at it as well. And it's designed as a 4-panel. So you've got PEF12M, equity risk premium, the total equity discount rate, and then you're just looking at EPS trend rates over time, and you're looking at the cycles. So you can see we had one cycle here in 08 and 09, and obviously the COVID-induced cycle that we're in right now, which brings me to the very first point. When discussing PE multiples with anyone, or when you're reading the Wall Street Journal, or you're listening to CNBC, or doing anything related to PEs right now, do not use the forward 12 PE because of this earnings trough. Again, we've got a lot of reopening phenomenons taking place. We need to basically look further out than even the 12-month to get through this earnings trough and to more normalized earnings. So we're getting an artificially high PE ratio right now because we've got so many troughed earnings. And this is artificial because the buy side is actually looking through the trough into 24 months forward and even 36 months forward. So the very first thing I'm going to recommend everybody do before they do any sort of PE multiple expansion or contraction analysis, specifically on the market, is to go and change that PEF12M to the longest time frame you can find. In this case, I'm going to go out to PEF2. And you'll see that it actually tapers that PE growth just a little bit. And that's what we want to do. That's a more realistic look at a normalized PE ratio, something that an institutional PM would do as well. And what I want to call everyone's attention to is the fact that we do have a nice multiple expansion in the market. underway. And everyone's question to me is, how much further can this thing go? And the answer is actually quite simple. If you look at equity risk premium relative to its own history, and I want to take everyone back to this point of 4.2. You can see that we're currently sitting at about 3.96. Keep in mind, generally speaking, as equity risk premium declines, you will get an expansion in forward multiples, and you can see that, right? We've been declining on equity risk premium since the end of 2012. Generally speaking, if you were to draw a line here, least squares fit, this line would be downward sloping. And obviously, by the end of 2012, if you were to draw this line here as a least squares fit, it would be upward sloping. So the idea with equity risk premium is it's a tremendous indicator of forward PE multiple expansion or contraction, or the likelihood of forward multiple PE expansion and contraction. And that's what we're seeing here. When we start talking about absolute levels of equity risk premium themselves, it really doesn't matter these specific points. It's where they fall relative to their own history and where the PEs themselves have trended throughout that same period of time. So if we try to compare this PE to a PE, say, back in the end of 2012, we would say, well, the market seems a lot more expensive, right? And I'm going to go ahead and do the display data and show you what I mean here. We would say, well, back at the end of 2012, this is when we were going through all of our quantitative easing cycles. We were trading at a PE of 12.85, okay? And now we're trading at a PE of 20.7. Well, we're trading at a massive premium. Yes, but not necessarily, because we had an equity risk premium of 8% relative to where we're at right now, which is only an equity risk premium of 3.96%. So I keep hearing from advisors, oh my God, the market is so expensive, this thing is going to crash and burn. And I ask them, is it really? Because you can't say the market is expensive today without looking at where we're at in terms of equity risk premium. And when you do that, you'll see that, wow, this market really isn't that expensive. If you look at what equity risk premium is, it's what investors require in terms of excess return just to put their capital to work in the equity markets. They were demanding an extra 8% in terms of equity risk premium, which is why PE multiples were so low at the end of 2012. And as that equity risk premium has come down to less than half of that, it's no surprise that PE multiples have almost doubled, especially when you couple it with the total equity discount rate decline. So interestingly enough, we've had the total equity discount rate decline at a faster rate than equity risk premium. And that is because the total equity discount rate in a macroeconomic terms that we are using in this particular chart is basically representative of the equity risk premium plus the risk-free rate. And we all know what happened to the 10-year treasury that we use with the risk-free rate during this pandemic period. It's collapsed. And so if you look at the total equity discount rate relative to its history, you can take this back to the dot-com bubble and say, we're really cheap now relative to where things were in the dot-com bubble. And we actually have real earnings in technology stocks, not just, pie in the sky earnings and revenue growth. We have real earnings. We have real numbers. But we also had a total equity discount rate of 8% here. We're at a total equity discount rate of 4.52. So theoretically, this multiple can expand even more than we're at now. As a matter of fact, we could drive equity risk premium down to levels that we saw back here, 2.61. Equity risk premium has actually gone much lower. It can actually go negative during times of hysteria, and it has. And you can see that if we were to bring this equity risk premium down even further back to 2000 levels, which it can go, you're going to get more of a PE multiple expansion. So when people ask me, oh, I'm afraid the market's going to, collapse, we're overheated, we're this, we're that, and I just point them, to this particular chart and let them draw their own conclusions. And keep in mind that we've grown earnings fourfold since that same time. This market is not overvalued, and related to equity risk premium and total equity discount rate, this multiple can expand even further. And so I just wanted to bring that to your attention. If anyone in sales has clients that are panicking over where we're at in the market, as we're speaking right now, the NASDAQ is making new highs. Please let me speak to them. I will show them these charts and educate them on how to use the equity risk premium, relative to its own history, how to look at PE ratios correctly. Keep in mind, again, I know I've said this, I'm going to say it one more time. PE ratios expand and contract for two reasons. They either expand and contract because the company itself is doing something either not so good or really good, which will cause a PE ratio to go up or down, or we have some sort of macroeconomic headwind or tailwind that's causing a PE multiple expansion or contraction that's going to be almost equally applicable to the entire market. That is what equity risk premium as a macro factor is measuring. It's measuring that portion of a company, or in this case, the S&P 500 composite, a portion of its PE multiple expansion or contraction that can be attributed to these macroeconomic either headwinds or tailwinds. Keep in mind that the best way to eliminate the macro factor involved in a multiple expansion or contraction is to simply do a relative chart. Because if you take one PE series for AMD and divide it against another PE series for Intel, like we can do right here, what ends up happening is you eliminate the macro impact and you're looking at simply Intel and AMD's PE ratio organically. And most people don't realize that that is the reason for doing relative analysis. The reason you do relative analysis is to eliminate the macro factor from your analysis. And that's part of the education that I like to do with our prospects and our clients. So if anyone has any questions related to that, please, if clients have questions, send them my way. And I'm going to go ahead and show you what I mean by this right now. So I'm just going to throw AMD up here. And since I said it, it may not be the best tickers to look at. AMD is a cyclical. Let me just throw Starbucks versus Dunkin' Donuts up here. All right, here's Starbucks and here's Dunkin'. And basically what we're doing is, if we look at this in absolute terms, we've got macro factors influencing maybe Starbucks and Dunkin' a little bit differently. But once we divide these two series by clicking on relative, we eliminate the equity risk premium impact. And now we can actually do an organic, how is Starbucks business model viewed from a valuation perspective relative to Dunkin'? And that is exactly why you do relative analysis. You can see that currently we're trading at a 33% premium. Over this, I'll just do a history right now, over this 10-year chart, right mouse click, we're looking at a 1.1 median. So normally it trades at a 10% premium. We're currently trading at a 33% premium. So if we were looking at buying either Starbucks or Dunkin', I would want to know why the buy side community is paying a premium over their 10-year median in terms of a relative forward multiple for Starbucks over Dunkin'. And obviously, these are the discussions we can have with our clients. So I wanted to go ahead and just leave those thoughts with you today, and we'll pick up on this next week. Thank you, everyone, for attending.